This is our Forex blog for March 27th, 2012. I'm doing it the following day. I was busy yesterday and wasn't able to do the blog for the day. Like we do most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. So when you see, for example, the Australian here had quite a bit of strength for a while, but the daily, weekly, monthly trend's down and it starts showing some weakness, that's a trend that you want to sell. You could sell it against the Swiss, because the Australian's on top, Swiss is on the bottom. You could buy the Euro Australian because you have the strong Euro, weak Australian. Yesterday, a little bit later, around 8 o'clock, the pound became the strongest of all the currencies. So you could trade it against that one as well. So let's bring up a chart and go back to yesterday and take a look at these. Euro Australian. Again, this is yesterday. We're going to be looking at it. Yesterday's trend carried through to today as well. And you can clearly see, very strong uptrend. And there's really two entry methods. Once we identify a currency that's likely to go up, we have really two entry methods. One is a multi-hour sideways rectangle pattern breakout. And the other one is just simply a pullback where you have a move up. You draw your trend lines over the pullback and you get into it. And some of the trades are going to be small, 5 to 15 pip wins. Some of them might even be break-evens or losses. And some of them are going to be bigger. You always want to put your stop underneath a swing low, right here and right here. And always be aware of where the previous swing high is if you're buying. If it goes up to the previous swing high and can't break through and go sideways, you want to take your few pip profit. You might only have 5 or 6 pips in the trade, but get out. And sometimes you have breakouts that really only go 10 or 12 pips up and then fail. And in those instances too, you want to get out. Usually you're better off waiting for a pullback for a certain amount of time or a certain distance. My own personal preference is a minimum 15 pip pullback to 25 pips, up to maybe 40 pips maximum. Once it starts pulling back too much, then the uptrend might be over. And you also want to draw your fibs on there to know how much of a pullback you have. Here's this first wave up. It pulled back. It wasn't even able to hit the 38% retracement. That's a sign of strength. Same thing later on the next move. It just keeps kind of going sideways. It makes slightly higher highs and then goes sideways. And ultimately, when it does break out again, it goes to this fib target of this first big move, and that's where it stalls. But again, the Swiss also was strong yesterday and the Australian weak. So you want to sell the Australian Swiss. And this one also carried over today. And you can see that especially at 5 o'clock right here, when the Swiss really becomes strong, that's 5 o'clock right here, and you might miss the first move when you notice something like this, and then you're looking to sell this move right here with your stop right above the high. Anytime it goes my way and then kind of comes back up, if it starts going down again and can't continue, I'm out. So I would have been out of this trade myself right here, and then you would have to re-enter it once it breaks down underneath these lows right here. You draw your fibs on the previous swing, and most of the time it's a great place to get out of the trade. You're getting short somewhere around 96, and your profit target's down here at 76. So it's 20 pips away. Most of the time we're risking 6 to 12 pips, and anytime your profit target is 1.5 to 2 times more than what your risk is, you should take the trade, especially using the currency meter. Now this is kind of a small profit. There are ones where you're going to find are 30 to 50 pips. For instance, the pound right here, the pound Australian tends to be a more volatile currency. At 7:30 right here, the pound got really strong. Pound Australian yesterday after 7:30 was another one to be looking for. Here's 7:30 right here, and you have a breakout pretty much of the day's high about an hour later. And notice, it goes up here from around 80 all the way up to 40. It's a 60 pip move. And if you missed the first breakout move, you might not have been able to get into this trade on this little pullback. And it becomes riskier to get into a trade when you don't have much of a pullback. But if you are going to take a trade like this, have a very, very tight stop underneath that swing low. Be very conservative of what your profit target is. Draw your fib on that last little mini wave. And most of the time, if you get out to 1.382, you're not going to give up too much additional profit by waiting. You're out of this right here at 28. If you had taken this trade right here at 06, you made 22 pips while risking about 10. And that's about as good as you can do when you get into, a higher risk, lower odds trade. Like once it's already taken off, you don't know if it's going to continue back up. It might stall here at the high. And let's say you got into this trade. Here's how you handle it if it doesn't work and doesn't perform like this one did. If it comes up here and starts going sideways, or even if it just slightly breaks out over the high like that, move your stop up. At least cut it in half. At this point, you're risking 4, 5, 6 pips max. And if it goes up another few pips, move your stop to break even. And then if it just sometimes you have false breakouts, it goes up 5 or 6 pips and goes sideways, move your stop up underneath, those bars low. And if it comes down and stops you out, you have a small profit or break even. If it doesn't, then, you can stay in the trade. And you're always able to use our intelligent trailing stops, or you can just yank up your stop underneath either the previous bar's low or 2 bars low. So you can say in that case you got out right here. But at least you made, if you followed it like this and didn't wait for the fib target, you made 15 pips while risking maybe 6 to 8 pips. And that, as long as you meet the risk versus reward criteria of 1.5 to 2 times bigger wins and losses, then you should be fine as a trader, especially focusing on ones that are likely to trend, like the weak Australian versus a strong pound, strong Swiss, and strong euro.